There have been a lot of experts come on this show wondering if the stock market was inflating a bubble. Zach Jonson, Senior Portfolio Manager at Stack Financial Management, he's not wondering at all.
Our general view, just to put it quite bluntly, is that we are in a bubble. And at this point, we've had that view for quite some time. We'll go with the old adage of not wrong just early, just because that's what us market people like to say.
Even though he says we're looking at a trifecta of bear market risks, he's not bailing out of this market, and he doesn't think you should either.
We think with the valuation risk and with the excessive hype that you could definitely see something that's one of the great bear markets of our lifetime. But you have to be careful of when you jump in front of that, because like I said, these things can run a lot longer than you anticipate. And that's why I say from a stepwise progression, be defensive, be aware, watch the technicals, and see how this unwinds.
But we start today finishing our coverage of the Active Investment Company Alliance Fall Roundtable in New York City with David Tepper from Tepper Capital Management. And later, Charles Rotblatt joins me to discuss the latest sentiment survey from the American Association of Individual Investors before Daniel Ducina talks unappreciated quality stocks in the market call.
Believe it or not.
Well, you had better believe that we are living the money life for November 21st. I'm your host, Chuck Jaffe. Thank you for joining me. Whether you believe or not what you hear from Zach Jonson, it is a powerhouse interview. And Stack Financial Management is a sister firm to Investech Research in the Investech newsletter. And they have been talking about bubbles for a while. And flat out, when you hear this, if you have been listening to us talk technicals and you've been hearing us discuss the Hindenburg Omen, I will just tell you, I should have asked Zach about it. The Hindenburg Omen is about the market reaching highs when a lot of companies are reaching record lows. They have a different indicator that they use, which he does discuss. I should have probably followed up. I didn't, because I was trying to get so much in. And speaking of getting so much in, this is a jam-packed show, so I'm going to keep this super tight because we're trying to stay close to our footprint, and we're not going to be able to do that. But thank you so much for joining me. Remember, you can reach me at chuck@moneylifeshow.com. And the fact that we keep this short doesn't mean I don't want you to hear from me. And it certainly doesn't mean I don't want to hear from you. Super busy right now, but I'll have some time in the holidays, around the holidays, to answer some questions and letters. So don't be shy about sending them. Meanwhile, we've got great stuff. And this interview with Zach Jonson, it is an eye-opener if you like technical analysis. But David Tepper, really good money manager using closed-end funds. He was on the show recommending some. We'll circle back with him. Always great to discuss things with Charles Rotblatt, especially when it involves investor sentiment. And sentiment kind of works in a counterintuitive way, and a great market call for you. So it's a great day to live the money life, and we'll prove that when the talk starts right after this message. Welcome to The Navigator at the Active Investment Company Alliance Fall Roundtable. The Fall Roundtable held in New York City at the View on the Battery on Wednesday, November the 19th, brought together a wide range of folks in the closed-end fund space. We're happy to have with us now David Tepper. David Tepper was last on The Navigator in September of 2023. And I will point out that he is the rare guest where I don't get to give you a website to say, here's David Tepper's website and you can check him out. You cannot do that. But he is easily found online because he is a longtime investor in closed-end funds who's been very successful at it. I'm very pleased to say, David Tepper, it's great to see you. Thanks for taking the time.
Chuck, my pleasure. Thanks for the invitation.
So I want to go back because I doubt you remember the specifics of our conversation at the beginning of 2023. But at the time, you looked at 4 of the oldest closed-end funds. They were Adams Diversified Equity, Central Securities, General American Investors, and Tricontinental. They are 4 closed-end funds that at the time you had owned for decades. They were trading at attractive discounts, and which you said, you know, look, if you're looking for closed-end funds that have delivered and are going to continue to deliver, these are 4 that are going to work. We've seen a lot of changes in the fund industry, in the closed-end fund space. But is the tried and true, the go find the old ones, the ones that have been there for a while, and if you find them on sale enough, buy them? Is that still the basic recipe here?
Well, yes, I think so. If particularly if people are interested in those particular funds in capital appreciation, long-term growth of capital. They're not necessarily high yielders offering a lot of current income, but since we last spoke, they've all done well. General American Investors is up over 20% this year. We'll be making a large capital gain distribution before the end of the year. Central Securities has a very interesting holding. There's a private insurance company that they invested in 25, 30 years ago, I think even longer. And the dividend that they're receiving from that company is far greater than what the value of the money that they invested way back when. And I think that particular asset, which comprises 25% of the assets of Central Securities, is on their books at a value that's well under what the shares could be worth if that company ever became public.
The industry has seen a lot of growth and changes, and there's more coming. We're going to see probably some more specialized funds. We've seen a lot of things into private credit and private equity and some other things along those lines. How much of those attract you? Because as you said, you've been doing these for a long time. These are the classics. How much does the new stuff attract you?
Well, again, as Howard Marks, the famous investor, said, there are no bad investments, only bad prices that you might pay for them. At this point, private credit is, I don't know if you'd say under a cloud, but people worry legitimately about what would happen if we had a severe recession, and you saw a lot of defaults in the credit space. And so I'm not necessarily in a hurry to buy them, but again, at the right price, under the right circumstances, they could present a tremendous opportunity.
That cloud for private credit and private equity, everybody talks about it, but at the same time, there was a lot of talk about what was going to happen in high yield and other areas of the bond market when we saw rates increase. And we never saw a significant increase in default rates as the rate cycle changed. Now we're in a rate cutting cycle. Do you think there's something structurally that's kept us away from the defaults, or do you think, no, it's you sort of said it's a legitimate worry, but is it truly a legitimate worry? Like we'd see a significant number of defaults?
Well, it would all depend on what happens with the economy. If and when we have a recession, you are correct. Rates are high. I mean, it looks like things are heading south, the Fed could cut rates. That would give a lot of these borrowers more breathing room. It would lower the cost for closed-end funds that use leverage. So, that's the one positive thing that could prevent a real meltdown. But I was in the business in the early 1990s when Drexel Burnham, which was the leading player in the high yield space, went under, and it rippled across all the closed-end bond funds. And the problem is when bad credit defaults, it's unsaleable. And if a fund manager needs to raise cash to meet redemptions or for liquidity, if they can't sell the bad stuff, they wind up selling the good credits. And so that puts pressure on prices across the board. I'm not predicting this is going to happen, but in this business, you never know. Anything can happen, and sometimes does.
One of the things that we haven't seen a lot of late is a lot of shareholder activism. You quoted Howard Marks talking about anything can be a good investment if you're getting it at the right price, and everybody loves a good discount. But discounts at this point, they'll widen out, but they don't seem to stay wide for long. To be a good closed-end fund investor now, do you have to be more nimble? Do you have to take advantage of suddenly the market changes and whatever, and you have a temporary disruption more than you did in the past?
Yes, I think so. I think there's more institutional type money in the closed-end fund space. You do have to be more nimble. I mean, if you are really driven by discounts, and I'm not saying that's the best way to, some people are, I'm not saying that's the only way to invest in closed-end funds, but it would appear that discounts are narrower than they have been. Now, another reason the discounts are narrower is that some of the activists have put pressure on various closed-end fund families to address these big discounts, and they've enacted policies paying out more higher distributions. that inherently have, in fact, narrowed the discounts. Funds have merged. Some funds have liquidated. The Pioneer Group had 5 or 6 closed-end funds that they liquidated them all earlier this year. They've taken money out of the pool, so to speak. So there's at least as much money chasing fewer funds, and that's another factor that has narrowed the discounts.
Fewer funds on the one hand, there's a lot of talk about what could be next and how the closed-end fund business is expanding. I am curious, as we did for a time see the Grayscale Bitcoin Trust be a closed-end fund, et cetera, but now Bitcoin and crypto funds have moved away from the closed-end fund structure. I am curious, are there assets you would never want to see in a closed-end fund? And are there assets you wish, like are you waiting for somebody to give you the AI closed-end fund or something along those lines?
Well, you've mentioned a couple areas that I'm not inclined to invest in for better or worse. Lately, it's been worse. Crypto, that type of stuff, I've steered clear of. And again, I've been wrong to do so. And I personally don't have a big tilt towards technology. There are 1 or 2 AI funds that do have a tilt towards investing in AI. Again, that's not an area that I'm naturally inclined to pursue.
So what would be the area that you would be inclined to pursue that you're hoping somebody opens a closed-end fund about?
Geez, nothing comes to mind at this point in time.
Let's talk generally about where you feel this market is, because we've got a market that is at record highs. It looks like it's going to complete its 3rd consecutive double-digit gain year. Yet there's a lot of pressure that people going, okay, well, it can't go on forever, et cetera. Are you worried that the next step is going to be a small step down, we need to take a pause, or the next one's going to be, here's the recession we've all been waiting for?
Well, one has to be careful and look behind the headlines. Yes, the Standard & Poor's has had great returns, but again, those returns have been driven by a very, less, maybe 10 or 20 of the 500 stocks in the S&P. If you compare how the S&P has done on an equal weighted basis, where every stock is weighted in the same, there's a ETF symbol RSP that represents the S&P 500 equally weighted. You'll see the difference in return versus the S&P 500 ETF SPY. Last time I looked, it was 750, 800 basis points lagging the cap-weighted S&P. So in fact, we could see a period where the smaller stocks outperform while the big cap Nifty or the Magnificent Seven, so to speak, lag. And another area of the market that, has lagged badly over the last several years is small cap. I think over the last 10 years, again, ballpark numbers, the S&P has returned in the mid-teens annualized over the last 10 years, whereas the S&P 600 or the Russell 2000 small cap has an annualized return of less than 10%. So not all stocks are undervalued or overvalued. And going back to the dot-com bubble that burst around 2000, in the subsequent years, small cap stocks did very well. Utility stocks did well. REITs did very well, while the big cap, the Oracles and the Ciscos and the Intels, the Microsofts, some of those stocks were down well over 50%. It's, as the saying goes, it's a market of stocks, not a stock market.
Well, thank you so much for taking the time to talk with us about it. David Tepper, great to have you join me here.
Thank you, Chuck. Always a pleasure.
That's David Tepper from Tepper Capital Management. I tell you that you could learn more about the firm at a website, but he doesn't have one, so you'll have to find him some other way if you want to learn more about Tepper Capital Management. We're just getting started on the Friday, November 21st edition of Money Life. Up next, we're back to the action from the studio, so stick around. There's much more to go right after this message.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Logic dictates that given their extremely high level of technical development...
Well, it's too technical to explain to the lay mind.
It is not too technical when you talk to the right minds, and that's what we do here on Talking Technicals on Money Life. And the right mind you're going to hear from today, Zach Jonson. He is Chief Investment Officer at Stack Financial Management, which, among other things, publishes the InvestTech newsletter. It is a sister firm to Stack Financial Management, the InvestTech newsletter. You can learn about Stack Financial Management by just knowing the name of the firm and going to stackfinancialmanagement.com. Zach Jonson, it's great to have you back on Money Life.
Thanks, Chuck. Good to see you again.
These are interesting times, and some of the most interesting research I have read as we have watched the market get back to record highs and people have started talking bubbles has been stuff that I have seen in InvestTech. Now, I know your sister firms, it doesn't mean you always, come to the same taste after having shared the water at the water fountain, but I got a pretty good sense of where you are on this market. Explain to the audience, are we looking at being able to sustain this? What's the problem that might be coming down the pike?
Yeah, absolutely. And our general view, just to put it quite bluntly, is that we are in a bubble. And at this point, we've had that view for quite some time. We'll go with the old adage of not wrong just early, just because that's what us market people like to say. But really, from an overall standpoint, we like to call it a trifecta of bear market risks. And that really comes down to, number one, equity market overvaluation. And we've really had overvaluation to this level only two other times in history, and that's 1929 and 1999, and of course today. Then the second part of this trifecta of bear market risk really comes down to that overconcentration as well. When you have overvaluation with overconcentration, meaning that the S&P 500 is so extremely concentrated in one segment of the market, when you look at from a sector standpoint, it's almost 40% in information technology. But if you actually look at the companies that are so tech heavy, so AI related, you can push that upwards of 50% of the S&P 500. Very focused on one segment that, of course, is receiving all the headlines, all the CapEx spend, and we all know the story behind it. But that level of concentration is extremely dangerous if that thesis or that idea starts to unwind a little bit. The last bear market risk, it comes down to the housing market and the unaffordability and the overvaluation that we also see in that segment of the market that is so important from a macroeconomic standpoint is also extremely excessive. And there's ways to fix this unaffordability problem, whether it be interest rates coming down. But historically, when you look at unaffordable housing to this level, it usually is not pretty the way it comes down. And that can really affect the overall market. It can affect the economy. So that trifecta really leads to kind of a multifaceted bubble that makes us really concerned about how will this unwind and how do you invest through it? We don't want to be perma bears where you sit here and just put everything underneath the mattress. And instead, we just really do think there's a way to be actively risk management or an active risk management approach to getting through this environment.
So what do you do to manage risk in this market, in this environment? If that's what you're focused on, what are the steps you're taking?
I want to tie this a little bit back to the technicals because I think it's important to kind of watch the market technicals for when is this going to start to unwind. And I think if we look at this year holistically, because I think this year's been very fascinating. We started off with an almost bear market in the first 4 months of the year. And it's amazing to me how quickly that's been forgotten because, of course, once we ended up getting through what many people are calling the tariff tantrum, once we got on the other side of that sell-off, which ended up being about 19% in the S&P 500, you quickly had this large rebound of about 38%. So investors have very short-term memory. That was quickly forgotten. But before that sell-off took place, we saw some pretty significant technical red flags that I want to point out because we're seeing the same thing happen, or we've been seeing the same thing happen over the last couple of weeks, or last 3 to 4 weeks, leading up to what we believe is another near-term top. So first is the AD line or advanced decline line, which really looks at what's the participation in the market. Prior to January of this year, we saw the AD line really start to collapse in the latter part of 2024. Of course, that was a good signal that participation was very weak. We also started to see that over the last few weeks leading into the latter part of October. So that was our first signal that these blocks are starting to fall into place once again from a technical standpoint. The second one, and I speak about this, I think, every time I come on here, because Investec's proprietary index, the negative leadership composite, is so important to us because of how it looks at the market holistically. And it really looks at new lows. There's an important behavioral side to the investor behavior of selling a stock at a new low. And for the first time since earlier, about December of 2024, we've seen what's called distribution, which is a massive increase in selling stocks at new lows. We've seen that appear once again. And so for the first time, like I said, since the latter part of 2024, distribution showed up in our negative leadership composite. And we like to jokingly say that's a big slap across the face that no matter what you're looking at from a fundamental perspective, or maybe what the Fed is doing, when the negative leadership composite starts to scream that we've got more downside ahead of us, it's something you need to listen to. So those two signals to us are a real cool technical indicator that we need to pay attention to. So jumping back to your question, Chuck, and sorry to go down that route, but I thought it was important to bring the technicals into this. From an investing standpoint, the first thing is avoid the riskiest segments of the market. And like I said before, with the concentration being in tech and AI, you can see how quickly the thesis can change and how quickly these names can move. And so we've been heavily underweight and, quite frankly, almost holistically avoiding that area because of the risk in them. On the other side, you do have left behind value segments of the market that are trading cheap. You have single digit PE stocks that are in healthcare, and healthcare's actually really caught a bid over the last few weeks. You also have consumer staples companies that have really been hurt by inflation over the last few months. But if inflation starts coming down, they've got a way to actually get their pricing power back. And these are very inexpensive stocks. So number one, avoid the riskiest areas. Number two, look to take advantage of segments that look attractive. And number three, you might look to take some sort of hedging position. We did implement an inverse S&P 500 index fund on our managed money, a position that to us is offsetting some of the riskier holdings that we might have. But some of those investing moves help you manage the risk in the near term while you watch to see how this unfolds from a technical standpoint.
We started this and you said we are in a bubble. If you said we are experiencing a correction, people would say, okay, that means 10%. If you said we're in a bear market, that would mean 20. What's in a bubble? Because there isn't a real definition for it. There's just oh crap, when it pops, how far could it go? So how bad is this bubble when it finally bursts?
And bubbles historically are very hard to time. Let's be honest about it. You can sit there until you're blue in the face and say that this is a bubble, and then it just keeps running and it keeps running and it keeps running, and you get steamrolled. So one of the important things is, from a risk management perspective, is how do you watch the steps, and when they start to fall in place, how do you actively manage that? So going back to your core question, let's go back to the tech bubble. I still think it's one of the best corollaries, or it really lines up with what we're seeing today. During 2000, starting with the March peak in the S&P 500, you actually had utility, staples, and healthcare produce stellar returns. And this is while the NASDAQ was unraveling very quickly. NASDAQ was down 40, 50% before people really even realized this was the beginning of the unwinding of the great tech bubble. So from our perspective, position yourself in the areas that are less risky. And then let's watch to see where this bubble goes and watch to see where the AI stocks fall. Now, what ultimately that did lead to is a 40 to 50% downturn in the S&P 500. The NASDAQ fell over 80%. Do we think that that's possible in this market? Absolutely. We think with the valuation risk and with the excessive hype that you could definitely see something that's one of the great bear markets of our lifetime. But you have to be careful of when you jump in front of that, because like I said, these things can run a lot longer than you anticipate. And that's why I say, from a stepwise progression, be defensive, be aware, watch the technicals, and see how this unwinds.
Is there a way to have a bubble burst where it's somehow a little more gentle and a little more, it just kind of settles down, as opposed to, think about a balloon where you let it go and it just kind of flies all over the room and then falls to the ground?
There always has been, and that's always been the argument of investors, is like, you know what, if we just let earnings kind of grow, for an extended period of time. If we let interest rates kind of settle down, your forward-looking expectations for returns right now with the valuations of the S&P 500 could be 1 to 2% over a 10-year period. And we could just sit here and muddle along. Unfortunately, what has always happened is the same irrationality that happens on the upside tends to happen on the crashing downside. So there is absolutely a thesis for we let this basically unwind in a very stepwise fashion and it's clean, but the market inherently is filled with a bunch of investors who are irrational. I mean, that's what we are. We are individuals with our money, and when it comes down to it, it's our opinion that that's not the way this is going to unwind.
In the defensive investing that you're doing, how much international exposure are you getting? Or are you not getting international exposure because you think the rally that we saw this year is much more about the strength or weakness of the dollar than it is about valuations? So you don't feel you're necessarily getting the bargain that you get to go overseas.
There's a great long-term thesis for international investing because of what you just said. The relative valuation for international stocks, whether it be Europe, whether it be Japan, whether it be emerging markets, is extremely attractive. That relative valuation differential is very attractive. And like you said, the dollar weakness this year alone has resulted in a first snap up rally that, even though it's very strong, it pales in comparison to what the valuation disconnect is. Our concern in the near term is if we do get the U.S. selling off aggressively, people still run to the U.S. dollar and they still run to the U.S. Treasury for safety. And so you get those two moves, you could get a snapback rally in the dollar that actually offsets some of the tailwinds that you have in international investing. However, to your overall question, I think if you have a 10-year time horizon, having an allocation to international stocks holistically and emerging markets to us is one of the areas that looks very attractive. And if we look down the line on the other side, one thing I want to be very clear about is AI holistically, we think it's going to change the world. And we think there's going to be a massive build out of data centers. There's a lot of need for raw materials and other things that come out of the ground to make this build out happen so we get the power that we need to make this work. That's a cycle that really points towards emerging markets. The last time we had that type of, we'll say, commodity super cycle was from 02 to 07. And the best place to be wasn't tech stocks. Post the internet bursting, it wasn't information technology. It was raw materials. It was energy. It was emerging markets. You could see that same type of transition, that same type of rotation take place in the next cycle. But I think you got to be careful in the near term, because if everything goes down together, you're going to have that opportunity to make that rotation at better valuations.
In your defensive positioning and trying to be opportunistic at the same time, where are you on gold right now?
We have a good allocation to gold. We did take some profits off the table because it had that meteoric move. Speaking of technicals, when you get something that makes that hockey stick straight up move to the point and investor adoption was so pervasive, we established this position 12 to 18 months ago in anticipation of this move. Once we started to really rally up aggressively, we took 1 to 2% off of that, but we have a strong about 4 to 5% position in gold that we're going to maintain as we look to hold that position, because in the end, we still believe there's a lot of, for lack of a better term, monetary malfeasance that's going on, and we want that protection of the hard asset through this.
If it's a bubble and the bursting is not that benign thing, spectacular fall off, and how long are we off? Because I don't think anybody's going to worry about a blow off until it's a blow off that then drags on.
Agreed. And I think one of the challenging things with this cycle is the buy the dip mentality is so pervasive. It's probably the most pervasive I've ever seen in my career, and you have mass adoption of this thesis. So there's no doubt in my mind that we're going to have steps down that are rebounded with very, very quick V-shaped rebounds. The true test of when this final unwind is happening is when you actually get stocks going down 10, 15, 20%. You get some buying power behind that, and then we get another 10 to 15% after that. That's when people really have that moment of realization to say, hey, that buy the dip, that surefire winning mentality of I'm just going to buy these stocks every single time and win on the other side of it. When that gets shaken up, And let's be honest, we have an investor class that is extremely young. We have a lot of both retail and professional investors that didn't even live through 2008, nonetheless the tech bubble that I keep referring to. And so that buy the dip mentality is going to be tough to break. But I think when that does happen, I think that does mean the duration of this could be a 12 to 18 month unwinding process. But again, I don't think that means everything goes. I think there's places to be, there's cheap stocks to hide in, there's value opportunities. And so that's what watching this and being careful for an elongated period of time. I don't think it's very fast. I think it's going to take numerous months to get through.
Zach, great stuff. If great also means terrible, it's kind of like the financial crisis, right? They call it the great financial crisis. I call it the horrible financial crisis. Always great to hear from you. I really appreciate the time. We'll talk again in 2026. Thanks so much for joining me today.
Thanks again, Chuck. Appreciate it.
That is Zach Jonson, Chief Investment Officer at Stack Financial Management. You know the name of the firm. You can find them online, stackfinancialmanagement.com, sister firm to Investech Research, which publishes the Investech newsletter. Again, you can get all that information by going to their website. And one thing we can forecast with certainty, there's a lot more to go on today's show, including Daniel Ducino from Blue Chip Partners. We'll be talking stocks with him, so stick around. We're living the money life, and we will be back at it in a flash.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Now Money Life looks at what the survey said. This is the survey said on Money Life. It's where we look into surveys, studies, polls, research or data that's going to help us understand what people are doing for, with, and about their money. And today we are looking at the latest AAII sentiment survey, which takes a look at optimistic and pessimistic and neutral sentiment from individual investors. Charles Rotblatt, editor of AAII Journal, is here. If you want to learn more about the American Association of Individual Investors, go to AAII.com. If you want to learn more about their sentiment survey, just add /sentiment survey to that. And of course, if you want to learn more about investing generally, Charles is the author of a book called Better Good Than Lucky. Yeah, you can find information about that if you go through AAII.com as well. Charles Rotblatt, welcome back to Money Life.
Thanks for having me, Chuck.
I don't think we are surprised that investors kind of act almost opposite of what we would think. The market backed off of highs this week. Where are investors going? Because I would have thought they would have been more pessimistic, because I'm getting more pessimistic sentiment from the experts.
We have to remember it's just about the level of market concentration and mega cap technology stocks. Going off memory here, but I think NVIDIA's accounted for about 19% of the S&P 500's returns to date. So out of 500 companies, one company's accounted for nearly 20% of the index's returns. And a distant second is Microsoft. Everyone else is well into single digits or less. When we asked members about it, close to 40% thought that the concentration in mega cap technology was a major risk. And another third said that's somewhat concerning. And the week before, we did ask them whether or not they thought the then government shutdown was impacting the economy. And again, we saw a pretty sizable number of members saying, yeah, I think it is hurting the economy. So I do think a lot of these headlines that are going on are affecting investor sentiment. And certainly they're looking around, they're seeing prices being higher. You're hearing news reports about people struggling. But in the background of this, what's not really discussed is that we are still having companies beat on earnings surprises. Earnings are still growing. It seems the economy is still growing, even though we haven't had updated government data in a few months. The economy is still going along, although there's certainly issues going on. And certainly we do have this K-shaped economy where a lot of people are struggling with the higher prices and affordability.
One of the things I'm hearing from experts a lot is we might be building a bubble. There may be trouble coming, but you ride the bull market as long as the bull is still moving forward. Your numbers in the sentiment survey are proof that Wall Street climbs a wall of worry, because bearish sentiment has been unusually high and has been above its historical average for the entire last year. 51 of the last 53 weeks, bearish sentiment has been above its historical norms. So Wall Street has been climbing the wall of worry. Does that mean that those of us who look at the numbers should get worried when the investors are less worried?
Usually when you see bear sentiment staying above average, it's usually a good sign for the stock market. We usually see the S&P 500 doing well. So it's this level of cautiousness means that you're not necessarily seeing this bubble that you hear talked about recently in the media really happening among our members. They do tend to be more cautious, and that's a good sign for it. Now, if they start shifting, being bullish, we'll see how high that bullish sentiment goes. But I do think you're just seeing a reaction to what's been going on in the economy right now. And I think we'll have to see how the market does. But this has been on net a bullish sign that we haven't seen really investors shift from being overly bearish to being overly bullish. So it does mean that they're being more cautious. But I will add at the same time, they're not rotating in the bonds. So we're still not seeing this fear getting to a point where we're seeing our members pull out of stocks or just nervous about what the short term's going to happen. And certainly this has been an eventful year with a large amount of headline risk going on, perhaps a little bit more than usual.
The reading we should have, given what we see, is bullish sentiment, below average, good, stay invested. Neutral sentiment, a little bit higher than we'd expect, also still a pretty good sign. Bearish sentiment, way above average, likely to stay that way for a while. There's your sign that keep going. But at some point, statistically, I know that does have to change. Like, it's coincident, it's not causal. There will come a time when those numbers backfire on us, won't there?
Well, I think there's a time when we'll see a shift on it. And, I think it's important to realize when you look at the numbers, there's what is the S&P 500 doing in the headlines, and then what's everybody's portfolio doing. And there's a big divide between the returns of the S&P 500. And I'm going to go back to this concentration. It's the concentration of the top 10 stocks of the S&P 500 relative to all others is 40%. So 40% of the S&P 500 market cap is attributable to just the 10 largest stocks. So, and when you look at the performance of the S&P 500 relative to the performance of the S&P 500 equal weight, same stocks, just different weightings, there's a huge gap. So I think there are a lot of people looking at the portfolios, if they're not fully indexed to S&P 500, or they're not really heavily allocated to those mega tech stock names, they're not seeing the gains in their portfolios that we're actually seeing being reported for the S&P 500 or even for the Nasdaq for that matter. So it could also be that some people are looking at their portfolios and saying to themselves, "I'm not seeing these big returns that are making all the headlines."
Yeah, the comparison between the equal weighted and the cap weighted has come up a number of times in recent weeks. And, just for the record, if you're looking at the Spider, it's up over 14% year to date. But if you're looking at the RSP, the equal weighted, well, it's up 6.5% roughly. So not even 50% of the returns and down near the bottom of its asset category. So you can see how that's playing out and that it's not necessarily, well, it's creating some of the bearish sentiment because, yeah, you've got an index that is going okay, but obviously not everyone's participating.
Absolutely. And I think that gets lost in the headlines when you hear these numbers, what's really going on below the surface. And if you look at mid cap, you look at small cap value, you do see small cap value starting to do a little bit better. But again, its valuations are well below the S&P 500. If you look at foreign stocks, again, the PEs are well below the S&P 500. So everyone's focusing on the down S&P 500, but not really understanding that when you go below the surface, it's a very different market than what you're seeing making the front pages of financial websites and the Wall Street Journal.
Well, Charles, great stuff as always. We love the insights and we appreciate that you'll come on the show regularly. We will see you again soon. Thanks so much for joining me.
Thanks, Chuck, and have a happy Thanksgiving.
That's Charles Rotblatt. He is vice president at the American Association of Individual Investors. He is editor of AAII Journal. By the way, he's author of Better Good Than Lucky. You can learn more at AAII.com. Add / and sentiment survey if you want to get directly to results on the sentiment survey. And your sentiment about money life, there should be nothing bearish or even neutral because we're not near the end of the show, so you shouldn't feel sad about anything. We'll be right back with more.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Daniel Ducina, Chief Investment Officer at Blue Chip Partners, is here. We're looking for unappreciated quality in stocks. It's time for the market call. Welcome to the Money Life Market Call. This is the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they are putting it all together. And returning to the show today is Daniel Ducina, the Chief Investment Officer at Blue Chip Partners. And if you know the name of the firm, you can find them online because they are at bluechippartners.com. Daniel Ducina, it's great to have you back on Money Life.
Chuck, thanks so much for having me. Always a pleasure.
Now, I said we're talking unappreciated quality, which it's not quite as simple as value, because you could say unappreciated quality might be value or it might be growth, because there's two words there that have to be defined. So since we always start with methodology, and since we know unappreciated quality is a big part of what you're looking for, explain the process and help us understand what goes into both unappreciated and quality.
Yeah, absolutely. I mean, it's funny because I think in today's day and age, at least for wealth advisors, for example, I think everyone gets so wrapped into the style box. The Morningstar style box has become this golden goose for asset allocation, when in reality, I just don't think it's that simple. Number one, I think any investor should be employing a methodology that can be flexible enough to navigate across said style box if the timing permits. And then also, given the gyrations in the economy or whatever your investment universe is, you need to be able to adapt. So when I talk about underappreciated quality, the underappreciated side of things is very much up to interpretation. And it's based on estimates that I have and our team has for firms in the future. I think a really good example of this, and this is not a disclaimer, we don't hold NVIDIA for clients at scale, but if you looked at NVIDIA's most recent earnings release, Wednesday, November 19th, we're recording this on Thursday, November 20th, you could sit there and say how overvalued NVIDIA is based on its trailing price to earnings ratio. Sure, I mean, that's fine, you can say that. But you could also make the argument that shares of the company are dramatically undervalued if you have a much higher expectation for earnings growth than the average person does. So what we try to do is find companies that we think can exhibit over long periods of time a high degree of not just growth, high degree of compounding with consistency. So we're looking for firms that are not just one-trick ponies, not looking for tactical moves. We're looking for businesses that are not just scalable, but can be durable in investment portfolios.
But we have to ask. So as you say, you're not really holding NVIDIA. So it's not on the scale of the potential to maintain the growth, or it's overappreciated.
Well, I think this is more of a portfolio construction conundrum because it's a good problem that we've had positions in companies like Broadcom and KLA. But the problem with adding an additional thematic position like in NVIDIA that's very highly correlated with other chip and chip related companies is that you run the risk of overconcentration. So I can sit here and talk all day about how constructive I am on artificial intelligence and the amount of power that's going to have to be generated to facilitate the continued build out of artificial intelligence. But I also don't think I would be a prudent portfolio manager if I went full bore and put 60% of client assets in things related to that theme. So this is more of what I would call competition for capital. I mean, we just have to diversify, and the horses we have in the race we feel like are good ones. And it's, again, no knock against NVIDIA. It's a tremendous company with tremendous earnings power, but you could find a number of companies in that related space that can say the same thing.
When you are trying to then build a portfolio and you like a space, which you've clearly said you do with things like artificial intelligence and technology, but you want to be fully diversified to do the right thing for your client, how are you then deciding what you're going to get elsewhere, or how you're going to load up? Because have got to be, just as your methodology could lead you to too much in the hot sectors, it could lead you to be underrepresented in the other ones. So how do you find, again, the right qualities in the areas that are not necessarily giving you the same growth picture?
Yeah, I mean, it's a good question. And to be frank with you, I think now is actually a really good time to talk about this because so much of the market over the last, really, if you include this year, 3 calendar years, has been driven by those high flying growth names, the Magnificent Seven, your artificial intelligence related players. But when we look at the forward outlook, when I think about diversifying, what I'm very interested in right now is buying businesses that I have a very high degree of certainty or a very high degree of visibility into what free cash flow looks like over the next 3 years. So I'll give you a couple of examples. And these types of companies are found across every sector. It's just a matter of identifying them. So, for example, if I look at industrials, outside of your, call it, power generation players, which I talked about last time I was on here, what I'm looking for is businesses that show me what I want to see over the next 3 years. Company like Union Pacific, where they're potentially going through the largest merger in industrials history, a very high degree of uncertainty with regards to volumes, which have been very depressed. We don't know exactly the dynamics that will come forth in 2026. I'm not super interested in that. What I am interested in is a company like Rollins, who owns businesses like Orkin. They're an insecticide company, incredibly boring, but also something that people will be incredibly unlikely to forego if they're already paying for it. It's basically baked into people's mortgages. So that's a company that I can see with a reliable lens what cash flow should look like over the next 3 to 5 years. The other examples, I would say a company like Zoetis in healthcare, even though I have a very constructive outlook for the whole animal health ecosystem, the problem is there's just an immense degree of competition. And so I don't know what that's going to result in over the next 3 years. What I do know is that T-Mobile is by far and away the best subscriber growth player in traditional wireless. And in an area where, or in a time when markets are approaching all-time highs and have been pretty much just rip roaring, I really don't mind the idea of going to a more defensive play like that instead of a Zoetis, where there's a lot more variability. So I guess the short way to answer the question is, I'm at this juncture, and you could probably make the argument that I think this way all the time, but I think it's especially important now to find companies that can satisfy that high degree of visibility into cash flow, because the way that we kind of look at the market right now, it's almost in this barbell fashion. We certainly have our growth oriented players in the tech space, artificial intelligence related, but that trade has worked really well. And I don't have a crystal ball to be able to determine, at what valuation do people start to get skittish. So I want to barbell that with some of your, call them sleepier companies. I think they're exciting because of what they can provide, but that's really how I'm thinking about it today.
It's a really interesting point, because only when you start to take that broad view of the market would you ever get a Zoetis and a T-Mobile in the same discussion. But again, that I'm looking for the consistency and the consistent demand. Aside from valuations, which you could then say, I understand what makes you sell, what else makes you sell? Because obviously something like Rollins, you're not going to see the demand change. Something like TMUS, you presumably won't. But again, you liked the demand with the Zoetis, you can't buy it now. So what makes you sell?
Yeah, there's a few different things. I could talk you through our portfolio construction triggers, things that would cause us to re-review a company. Those are price related, but also, if there's a fundamental change in a business, we re-review them. But what I would say is by far and away, the most common reason that we either move away from a company or trim it down in target weighting is something that I referenced earlier. It's called competition for capital. And it's basically just, what is your opportunity cost for continuing to own this business for clients? And is that opportunity cost becoming too large to ignore? So realistically, when we go and re-review a company, whether they're struggling from a share price perspective or have had some fundamental changes within the business or the industry dynamic has changed, if we go in and re-review that company and we come across a competitor or a differentiated firm that we end up liking better, our opportunity cost might just become too large for continuing to hold shares of what we already hold instead of, transitioning to a different position. This idea of competition for capital keeps us very much abreast of our entire investment universe. Obviously, if you have an investment universe of, let's just, for example, say the entire S&P 500, that becomes really challenging because there's just from a sheer numbers perspective, it's really hard to stay on top of every individual company and identify with accuracy where we should actually be moving in what direction. So what we've done to satisfy this to a certain extent is we keep a backlog of companies. I would call that, for any baseball fan, the on deck circle. So if we do come across a business that we're starting to feel a little bit less certain about, using the same kind of foundation of that predictability of cash flows over the next 3 to 5 years, the on deck circle becomes a place that we look. And if we look at the backlog and we see something that looks more attractive than something that is currently in our model portfolios that we deploy to on behalf of clients, that's probably the far and away most common reason that you would see us move away from a certain position.
I'm going to ask for something which you may not be totally comfortable doing, but give us an idea of a stock that's in the on deck circle. So it is literally something where you're not buying it right now. It's on your watch list, and help us understand that, like, okay, this is the kind of thing that we consider in the on deck circle, but you're making a buying case for, but you're not buying it yet because it doesn't rank enough to get over the hump yet.
Yeah. Well, I mean, I will tell you, even though I already talked about T-Mobile, that was a great example of a company that initially moved on to the backlog. When we reviewed it initially, we weren't comfortable making a full position swap, but we put it in the backlog, and then just recently made the full position switch. Another company on the backlog list right now is Walmart. Oddly enough, this is the second company I'm talking about, even though we're not supposed to talk with timestamps. But Walmart did report their third quarter earnings recently, but that's another company that's in the backlog. The only thing I would say there, we monitor it, but Walmart falls in consumer staples, and consumer staples is a little funky. But what I do know about consumer staples is we already have a position in Costco, and there's a very high degree of overlap in terms of business segments with regards to Costco and Walmart. That's not to say that we would never push Walmart into our models that we deploy to on behalf of clients by pulling Costco out. But it's just one of those things where, until I see some sort of catalyst for a Walmart or a negative kind of risk for a Costco, I don't know if that would be a change that would be likely. Where I could see a company like Walmart moving from the backlog into, a more formal position would be if we had just a very, very vehement view on the kind of consumer downtrade that we actually are seeing a little bit of right now. And when I say consumer downtrade, it's really consumers taking a little bit more of a cautious lens on spending. Your more value-oriented retailers like a Walmart benefit there. So, we try to keep the backlog what I would call relevant, meaning something shouldn't sit in the backlog for more than 12 months. Because if you review a company, it finds its way into the on-deck circle, and 12 months pass. Realistically, there's probably enough meaningful changes within the business that you need to either re-review it or kick it out of the backlog because it's not as relevant as it once was.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
This is the best. This is great. I love this. This is the best. I'm having the best time. I love it.
Well, we do think it's the best when you get to hear directly from fund managers about what they're doing and how it's working out and how they feel about some of your favorite stocks. And again, joining me to do this today, Daniel Ducina. He's Chief Investment Officer at Blue Chip Partners, online at bluechippartners.com. You know how quick and dirty works, so we are going to jump straight in, and we're going to start with a request from Steve in Royal Oak, Michigan, and Sam in Waterfleet, New York, because you mentioned it in passing, but I'm still not sure, given that we were just talking about the backup list where it is. It's for KLA Corp, ticker symbol KLAC.
I mean, I have a very constructive view on KLA. KLA is a company that fits in so well with the dynamics that are at play today with artificial intelligence. I think the niche that they have in quality control equipment is absolutely essential if you do believe that the continued build out of artificial intelligence and ultimately chip production is going to continue at the trajectory it will. So I like this as a much safer way to play what has traditionally been not so safe environment.
Just go slow and be smart.
Yeah, you're looking to be smart. You're going slower than with some of the other plays in that market, but that's a buy on KLAC, KLA Corp. Sam in Waterfleet, New York is in on our next request as well, which he shares with Greg in Tully, New York, both wanting to know about CMG, Chipotle Mexican Grill.
So I referenced this a bit earlier when I was talking about Walmart, but this trade down that you're seeing exhibited by consumers is starting to work its way into the restaurant and fast casual space. Whether it's Chipotle or Cava or Sweet Green, all of these players are starting to struggle because consumers are being a lot more conscious on dollar spend. And that does not bode well, in my view, for the forward prospects of a company like Chipotle.
This looks extraordinarily bad.
Well, at the very least, it's looking worse. That's a sell or an avoid on CMG Chipotle Mexican Grill. Scott in Marblehead, Massachusetts, who has not written me for a while and sort of told me I've got a couple of requests and I'll wait till they're all gone. Scott, this is the last one, so I'll hear from you again, I hope. Wants to know about VKTX. That's Viking Therapeutics.
So I'm very constructive on the obesity space in general, at least from a pharmaceuticals perspective. I do have a preference for Eli Lilly here, but what I would say about Viking is, as you've seen some of their data come out, and it has been fairly compelling, I think you might start to see some of the big pharma get involved with some potential acquisition opportunities with Viking. Not to say that Viking can operate and succeed on a standalone basis. I just think that the lead that a company like Eli Lilly has will tend to have it outpace Viking. But there is a bit of an opportunity for Viking when I look across the big pharma space in terms of acquisition potential.
So if you've got Viking, you're holding it from the sounds of it because you've decided it's worth that risk. But if you don't have it,
No money changes hands today.
no money's changing hands on Viking. But in there, however, was a buy instead on Eli Lilly, ticker symbol LLY.
Buy it outright.
Lance in Bethlehem, Pennsylvania wants to know about Adobe. It's ADBE.
Adobe's been such a head scratcher over the last year and a half or so because as their financial results have at least impressed me, you just have not seen them get any credit for it in the marketplace. I think a big part of this is because management has not been able to communicate effectively their strategy as it pertains to artificial intelligence and what that means for their future, essentially in the space. I'm of the opinion that Adobe has a fantastic runway within their business. The cloud, the document, the entire professional suite that Adobe has to offer. There are certainly economies of scale there. And so, this is an opportunity, I think, to buy what I would call a very high quality compounder in a very enviable kind of captive position in its segments at a pretty deeply discounted price.
Let's hit rock bottom. Come on, let's buy.
Yeah, at a discounted price, you can buy a long-term potential gainer. That's ADBE Adobe, and that was a buy. And last, for Dave in Jacksonville, it's Intuitive Surgical. That's ISRG.
Yep. A big fan of Intuitive Surgical. They clearly are industry leading as it pertains to robotic surgery. Recently released Da Vinci 5. Uptake on that new world-class machine has been very good so far. You're starting to see some momentum build. Their most recent print, when they talked about the second quarter, is starting to show that momentum for the Da Vinci 5. And that's what I think is starting to show up in share prices now. So I very much like the company.
So long-term prospects good. That's a buy on ISRG, Intuitive Surgical.
I'm in this for the long haul.
And while you might be into the stock for the long haul, we are short on time with Daniel Ducina. But Daniel, always great to catch up. Thank you for coming back to the show. Enjoy the holidays. We'll talk to you again in 2026.
It's my pleasure, Chuck. Always a pleasure to join you.
Daniel Ducina is Chief Investment Officer at Blue Chip Partners. Go to bluechippartners.com if you're looking for more information on the firm. And we'll come back. Daniel agreed and disagreed with a couple of guests who have been on the show recently. We'll tell you all about it before we wrap this one up, and we'll give you a hint for what's coming next week. And man, there are some great stuff coming. So set yourself up to get some excitement over the weekend and cross the finish line with me right after this message.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
So it's another week already.
Sure is hard to believe we've gotten there. And yeah, we've gotten there today with a jam-packed show, so I don't have time to reminisce about where the time has gone. Let's just jump straight in. That interview with Daniel Ducina, He talked about Zoetis. He had it as an avoid. Arda Logroniger from Logroniger Partners was buying it back on October the 29th. Daniel himself was buying Zoetis when he was last here on February the 28th, though he talked about why he's changed his mind now. T-Mobile, TMUS, was a buy today. Nitin Sacheti from Papyrus Capital was buying it on October the 14th. Walmart was a hold. It was on his backlog wait to buy list. Stephen Gray from Gray Value Management was selling it on October the 17th. Then during Quick and Dirty, you had Chipotle, CMG, as a sell. Tom Martin from Globalt Investments was selling it on August the 18th. But by the way, it was the poster child for David Brady on May the 12th. I know it was his, that's more than 6 months ago, but still, since it was poster child, I figured I might as well mention it since I knew it. Then, in not really loving Viking Therapeutics, he said what he liked in the space was Eli Lilly. Mark Dixon from Horizon Investments was buying Lilly on November the 13th, so just about a week ago. You had Intuitive Surgical. Well, really interesting there because Ed Schill, back from Wealth Enhancement Group QCI team, liked it, but had stops in place back on June the 23rd. He was protecting against a downturn. It was trading at 5.15 at the time. It got down to about 4.30 in October. So you'd think his stops might have triggered. But man, has it been ripping in the last month above 570. So I don't quite know what to make with that crossover there. Next week on this show, oh my goodness, Amar Raganti, fixed income strategist at Hartford Funds. Marta Norton, chief investment strategist at Empower. I'm super excited. She's going to be on Tuesday's show, along with Dom Rizzo, portfolio manager for T. Rowe Price Technology. And we'll have Julius DeKempenayer, senior technical analyst from Stock Charts. Come on. So I don't care that it's a holiday week. I got that. We've got much more stuff coming. We will be here on Black Friday. You should plan to be here with us. Meanwhile, if you are looking for something to celebrate today, it's World Hello Day. It is also International Stand Up to Bullying Day. And I'm just going to point out, Gail and I went to see the movie Nuremberg last night. It is with Russell Crowe and Rami Malek. And I would not call anything that happened in World War II to be bullying, though there are elements to it. But we should stand up to bullying a lot more internationally, globally, and everything else. And if you are not familiar with the story, it's a tremendous movie. It's not necessarily one that you're going to go like, what a feel-good story. That's not how it works. But as someone who is first-generation American with parents who escaped Germany, there's a lot in there that on the one hand is unsettling, on the other hand is a pretty good reminder for today. So I'm just telling you. It's also Substitute Educators Day. Come on, you got to appreciate substitute teachers. And then on the food front, it's National Cranberry Day, National Stuffing Day, and National Pumpkin Pie Day.
Wow, a pie!
Which makes it sound like it's Thanksgiving dinner day, doesn't it? And then it's National Gingerbread Cookie Day, which I actually associate more with Christmas than I do with Thanksgiving. But maybe you're making them now because it's, getting there. My guests today were David Tepper from Tepper Capital Management. No website to promote for him. Zach Jonson from StackFinancialManagement.com. Charles Rotblut from AAII.com. And Daniel Ducina, Director of Investments at BlueChipPartners.com, if you're looking for their websites. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from Francesco Guicciardini, who said, "The return we reap from generous actions is not always evident." No, it's not. But generosity is important, especially at this time of year as we head into the holidays and Thanksgiving. So find generosity of spirit. Get out there. Also have some fun with your family. Enjoy, everybody. And remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great weekend, everybody. Stay safe and calm. We'll see you here again on Money Life on Monday.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Looks like I picked the wrong week to quit sniffing glue.